Fair value gaps are a great tool to include into your trading strategy, but if you are interested in using them, you need to understand what actually makes a valid fair value gap that's usable. So we've broken down everything you need to master FVG trading into 7 easy-to-follow tips. But first, we need to know how they work. Here we have a series of 3 bullish candles, and within their formation lies a bullish fair value gap. The gap forms when there is a space left between the first candle's top wick and the third candle's bottom wick, which is also known as a bullish imbalance. To give a simple explanation behind why imbalances are important, the chart likes balanced price action, and to achieve this, it needs to see both buyers and sellers taking part in the moves. So when we have a move that involves only buyers taking part, this creates a bullish imbalance. And the same happens when only sellers are taking part. It creates a bearish imbalance. So with this logic, this area is a bullish imbalance because it was a strong impulsive move for buyers, meaning in the future, we can expect it to act as a magnet for price to draw into before continuing the upward move. And in doing so, this area has now been rebalanced. We then also have the bearish variation, which follows the same principles. The only difference is that the imbalance is to the downside, meaning we expect price to push into it from below in order to rebalance the area, before then continuing the next leg down. If there is no gap between the first and third candle's wicks like in this formation on the right, it means the price action is already balanced, meaning there is no fair value gap to trade. So now that we've covered what fair value gaps are, let's start off with our first tip, which is that you should only be using FVGs that align with the current order flow. Price can only go in 2 directions, but it rarely ever moves in one straight line. Instead, it makes many smaller moves which together create the larger swings. In the case of an uptrend, we know that in order for it to remain valid, we need to see it create new higher highs. But after a high is created, we know a retracement is expected. And when the price comes down, it needs to find some kind of support that it can use to create the next leg up. And this is where we would look within the previous leg to find a bullish fair value gap that can provide the liquidity needed to continue the upward move. We can see a good example within this chart here. Every time we see a higher high form, we then see a retracement back into a bullish fair value gap, where it finds the support needed to continue the upward move. As for downtrends, we know that in order for the price to continue creating new lower lows, it needs to find a form of resistance to create the next leg down. And this is when we would use a bearish fair value gap. We can see an example of this here within this downtrending structure. Every time a new lower low formed, it then retraced back up and into a bearish fair value gap, where it then saw resistance before continuing the move down. So to sum this up, during an uptrend, we only use the bullish fair value gaps that form, and during a downtrend, we only use the bearish fair value gaps. This makes sure we are correctly following the order flow of the chart. Now moving on, the next tip is that you should never use an FVG that has already been touched. For example, here we have a fair value gap, but if we look closely, we can see that the price has already dipped into it. Even though it barely entered the FVG, we still consider it mitigated, meaning it has become greatly weakened. And if we are looking for the highest quality fair value gaps, we may no longer want to consider using this one. But with that said, it doesn't mean this FVG will definitely fail if the price moves back into it for a second time. It's just a warning that FVGs that have already been touched should be considered weaker than those that haven't been. For our next tip, you should be targeting fair value gaps that are created within a discounted area. To give an example of this, here we have a strong bullish move, but when we mark out the fair value gaps, we have a few to choose from. So the question is, which ones should we be targeting for our trades? Well, the first thing we should do is mark out the top and bottom of the move, along with the 50% mid-level. This will give us what we call the premium and discount areas of the range. To put it into simple terms, if we are looking for a long trade, setups found within the discount area will always be the strongest. So when we now look back at the chart, these highlighted fair value gaps are the ones we should be targeting for our long trades. And we can do the same for bearish FVGs within a downtrend. The only difference is we want to be targeting the fair value gaps that were created in the premium area, which is anywhere above the 50% line. Now we are moving on to some of the more advanced aspects, starting with our next tip, which is that you should look to combine FVGs on different time frames for a more precise entry. Most traders using FVGs choose to take trades from either the top, the bottom, or the middle of the gap. And while this isn't a wrong way to trade, there is a better way to find a more precise entry. Let's say for this example, we found this FVG on the 4-hour time frame, which is giving us quite a large range that the price could potentially reverse from. So instead of taking a trade with such a wide margin of error, we can instead move down in time frames to find a more confined area. Here we are now looking at the price action on the 15-minute chart that created the larger 4-hour FVG. And when we look closely, we can see that there was a 15-minute fair value gap that formed during this upward move. This should be our new target for a long entry because it has the confluence of a 15-minute fair value gap within a 4-hour fair value gap, creating a very strong area of support. The next tip we have is that you should consider the third candle of an FVG the most important. Here we have two impulsive bullish candles, and just by observing these two candles, we already know the maximum potential size of the FVG before the third candle has even opened. But we aren't really interested in the size of the gap. What we are really looking at is the way in which the third candle chooses to form. For example, if we were to see the creation of a bearish candle like this, it creates what we call a rejection fair value gap, which we should avoid taking trades from. And the reason behind this lies with how the third candle that formed the FVG showed a large amount of strength for sellers. Which means whilst this gap may initially see a bullish rejection, there's a high chance that it will quickly fail. But on the other hand, if the third candle that created the FVG was an additional bullish impulsive candle, this is what we call a breakaway gap, and these are the FVGs that we want to trade. This is because it has shown an impressive strength for buyers. Breakaway gaps typically take longer to be drawn into, but they provide a much greater chance of providing a strong support for the next leg up. For tip number 6, you need to understand how to trade FVGs that form around a liquidity area because they can offer the strongest fair value gaps possible. Price is only ever doing one thing, and that is targeting external range liquidity, which is either a previous swing high or a swing low. And to get there, it uses internal range liquidity as fuel, or in other words, an FVG. But depending on how the liquidity is taken, price can do one of two things. In this first chart, we have a clear swing high that is our current draw on liquidity, and we then see a very impulsive bullish move that blasts straight through the level. This is what we call a liquidity run, which is when the price has completely disrespected the previous swing high, which confirms that we are continuing the bullish trend. And as for fair value gaps, we want to see a bullish FVG form within the move that broke through the liquidity level, as this will create the strongest type of FVG we can find, because it has the confluence with the liquidity run, which makes it a very high probability area of support. Then we have another scenario where we again have a swing high as our draw on liquidity. But this time, instead of the price bursting through the level, we actually see the candle fail to close above the line. This is what we call a liquidity sweep, which is when the buyers aren't strong enough to continue the move up. As for the FVG that formed here, we shouldn't consider using it for a long trade. And the reason being is due to the price failing to push over the liquidity level, as this signals that we are likely now flipping the directional bias from bullish to bearish, meaning we should now be looking to take trades within bearish FVGs to continue the move down, which follows the rule we made in the first step, which is that we should always follow the order flow of the chart. And for our next step, you're going to want to avoid trading FVGs during consolidation periods. The easiest way to make money in the markets is to trade during a trending phase, because all it takes is a confirmation of a trend continuation. And going beyond this, most traders will be able to successfully identify a trend reversal using simple knowledge of market structure. But then when it comes to a consolidation area, they end up repeatedly getting chopped up, not knowing which direction they should be targeting. This is because when we are looking for a bias and trend, we want to first see an FVG get respected. And from the move that then transpires, we want to see the creation of an additional FVG that can be used to further propel the price up. But then when we eventually see a bullish FVG fail, people immediately flip towards a bearish bias. But if the next bearish FVG that formed happens to fail too, this is when your instincts should tell you that there's a good chance we are entering a consolidation area. But if you're only interested in trending phases, you're going to wait to see when price next creates and respects two new FVGs, as this will give you new short-term directional bias. If you found this video helpful, please leave a like and then comment what trading concept you'd like to see us cover next.